Munot joins us. He represents one of the biggest AMCs in India, and let's understand from him that what his analysis of the current market mood is. So what should crores and crores and crores of investors do?
They should keep the faith on India's prospects over a long run. They should continue with their SIPs, and if they are sitting on some amount of cash, then next few weeks can give an opportunity to put that to work. And they should, in our words, we call it top up your SIP. They should be topping up, because if you look at the overall macro environment, political, social, macroeconomic and financial stability has been continuing. Balance sheets of both corporate sector and financial sector in good shape. We had GDP growth of 8%, inflation well contained. If you look at external sector, whether you look at our current account, whether you look at our balance of payment, whether you look at foreign exchange reserves, in a good shape. Relative to rest of the world, which is dealing with so many challenges, I think India stands out. And you mentioned about the unexpected event. So of course the expectations were different, but keep in mind that between 1989 and 2014, we worked with coalition governments, and Sensex went up from 750 to 25,000 in that period. And all the hard work that has been done in last 10 years is not going to go away anything. You tell me one reform that will get reversed. You tell me one policy that will have a derailment. Highly unlikely. I expect that I think the reform momentum continues. The good shape the macro is in, that continues, and India's standing in the world will continue. What an amazing democracy it is. So all of us as Indians need to celebrate that perspective.
Okay. Now what markets are today voting for is, they've not fallen a lot, but there is a big change. PSUs are down, capex is down, manufacturing stocks are down, and FMCG stocks are moving higher. Is the logic in assuming that the markets will remain intact, but the gainers and the losers will change? The laggards will become outperformers and the performers will become laggards?
Again, it's the alignment of the expectations. The stocks that have fallen in last, let's say, 1 day or so, are the ones which have risen substantially. I mean, look at the gains that have been made in last 1 year or 2 years. Even at the index level, at the beginning of the year, Nikunj, had I told you that government wouldn't get a majority, we are going to have a coalition government, you would say that Nifty would be down like 10%. We are
maybe
higher
more,
today, CYTD, exactly. And I mean, had I told you that US Fed won't be cutting, in India we won't be anywhere close to rate cut, etc., you would say that maybe market might be down 10%. Mid and small caps are up 5% YTD. I mean, anywhere between 5 to 7% at the index level, stocks would be different. I think it's a realignment of expectations. Wherever valuations had run ahead of fundamentals, purely based on the narrative, there is good news flow. News flow on, you talked about like the whole PSU basket or some of the others. But the narratives had run slightly ahead of the fundamentals. Valuations had gone up. Those valuations are correcting. The earnings growth story continues.
Okay. You have variety of schemes. You have sector funds, you have theme-based funds, you have hybrid schemes, you have debt, you have focused equity. Let's start looking at everything. I'll start with something which is standout for HDFC AMC. You have a manufacturing fund, you have a defense fund. These funds are essentially based on policy, what government will do and how the companies and sectors would benefit. What happens there in those schemes now?
No, in defense funds, we have been taking SIP for quite some time because of the valuations and the shape of the index. I think those investors would, I think in fact, they might have been happy that the stocks have corrected a bit, right? I mean, in SIP, the benefit is that the volatility helps you. You can actually beat that and take that to your advantage. And same thing is in manufacturing. I would continue to argue that people should put up SIPs, and if let's say market corrects more in those stocks, because the opportunity of China plus one, the opportunity to be one of the big factories of the world because of the domestic potential, the policy momentum, better infrastructure, bringing down the logistics cost, etc., and what PLI and other things have done, I think that has not gone anywhere.
So the idea of why you floated or why you raise money in a manufacturing fund and the defense fund, that policy thesis and that big picture argument is intact.
I mean, the defense fund, we didn't expect that in 1 year the NAV would almost kind of like double or so. I think the returns kind of got front loaded, but over a period of time, the earnings growth story still continues. I mean, I think Prime Minister recently mentioned about we want to be a large exporter, not only be Atmanirbhar in that sector, but we want to be an exporter one day. But again and again, I'll repeat one thing. I think wherever the valuations ran purely based on narrative, ran ahead of the fundamentals, you are seeing realignment of those expectations.
Nifty is down only 2% from its all-time high. With all the hullabaloo of yesterday's fall, markets
and
are up
I think
for
we
the
celebrated 20,000.
Yes.
I mean, it looks like yesterday, right? We celebrated 21 and 22 and 23. We are still there.
You know, I looked at a number, I think, before the crack. So I don't know the numbers today, but we've added $1 trillion of market cap in 6 months.
Absolutely.
See-
And that took several decades for us to reach there, yeah.
Okay. So I don't think there is panic. Let's be clear. The stock screen is not telling me there is panic, but there is a lot of curiosity. What is next? So how do you see the sequence of events now moving for the market?
I think a sequence of event is, a big event is behind you, right? We know what shape the government will be, but another thing, there would be a curiosity around whether there would be change in the policy dynamics, whether there will be change in the policy direction. To me, that's unlikely. Maybe some of the expectations on certain set of reforms that market wants, to me, they are not as critical as they are made out to be. Our economy is growing 8%. We have become the 5th largest economy from 11th largest economy, right? And some of those reforms have not been done, and you know what I kind of mean with those 2 or 3 we have been hearing for 30 years from all business chambers, and I would have written so many times about them. But I don't think that's that big a deal. I think the basic fundamental structural growth opportunity that we have, that continues. What we need to ensure is the political consensus that India needs higher growth. Even if somebody says that we need to do more welfare spending, we need to give more, maybe, I mean, let's say in their language, a handout. How will that happen? You grow more, you collect more revenues, and that's how you can give more money. There could be ways of like, how do you deliver that to make the growth more socially equitable and more inclusive. But that consensus across political parties that India needs higher growth, which is critical, and I think that should be good for the market.
Markets were reacting to announcements. An announcement came from the government, the market reaction was evident. Now, do you think the announcement would be replaced with evidence, which is look at the cabinet formation, 100-day agenda of not the Modi government but the India government now, and also what happens in budget? Do you think markets will wait for the evidence before bulls come back?
I mean, I tell our fund managers, I think pay less attention to some of that, you know, the news flow and the day-to-day movement, and that's why we would have done well over a long period of time. We celebrated 30 years of Balanced Advantage Fund. There have been many cycles, there have been a lot of those euphoric movements.
It must be the oldest scheme,
absolutely one of the oldest scheme with that kind of track record, and we have many others, and industry also has, I'm speaking on behalf of industry also as MFI chair. And we had like dark pessimism also. But across this period, keeping the faith on India that this is an economy that stands out in terms of the growth opportunity and the corporate sector, which is more important. Other than United States and few countries on planet Earth, you didn't have countries where for decades economy continued to deliver a nominal GDP growth of double digit. You have a corporate sector which converts that growth into revenues and profits, and a capital market with help from our regulators, people like you and all of us. They deliver the returns that corporate sector has generated, and a mutual fund industry where even with 500 rupee per month, you can make that return. This hasn't happened in many countries on planet Earth. I mean, US is one of the exceptions, and there are very few. That narrative doesn't change. This is the reason 24 out of last 31 years or so, I mean 1 year here and there, you can check your data, foreign portfolio investors have been net buyer of Indian equities. Because one, the macro opportunity, a stable environment and a growth opportunity, and second is the bottom of stock picking opportunity. I think a third dimension has got added now, which is the domestic liquidity, and I'm so happy you started your conversation with that SIP. That in all this conversation and curiosity, you should not forget that we have now a domestic investor base which is putting 20,000 crores every month into Indian equities, and that is only going to go up. Also, thanks to all your efforts.
No, I mean, it's a collective effort.
I mean, together we'll on that whole
effort. Yeah, it's a collective effort, and we look forward to more campaigns like that. There is a bull outside BSC, but there is another bull with the common man outside BSC. For me, that bull is more important because
absolutely,
there was between 2000 and 2010, FIs bought into India, they made money. Indians were not buying. They're recovering from the aftermath of 9/11 and the TMT crash. 2010 to 2020, sophisticated HNI investors bought into India. You saw the birth of some of the great HNI investors. 2020 onwards is where the SIP money is coming.
Absolutely.
Did you have net inflows yesterday? On a day like that?
In fact, just before coming, I checked. I was about to check, but my expectation is that the number of purchase transactions would have been very high yesterday.
Okay, so on bad days, Indians are buying. See, I want you to talk about this point.
I've seen that for a couple of years, last few years, that whenever there is, let's say, a panic, I mean, we haven't seen really a panic, but whenever there is any negative news on account of geopolitics or let's say global rate cycle or any other reason, our purchase transactions on those days go up, which means the maturity of the investor, they want to take advantage. They don't get swayed by the volatility. They want to take, and this is the hard work of, let's say, 25 years. We've got the track record of several of these funds. We've got the most transparent product thanks to the industry and regulators' effort. We've got the technology now that people can immediately top up their SIP, and the fourth is the training that we have been doing, the mutual fund Sahi Hai campaign, and all the fund houses are
so the mindset has changed, and the
mindset has changed.
Social media mindset has changed. So I'll ask you something which perhaps may not be a part of today's syllabus, but it's part of the overall picture. At least when I started my career, I was being told that the red mark for bull market is when IPOs are there and when retail is active. IPOs are there and retail is active. But even though retail is strong, you don't think the bull market is ending.
So it's a very interesting point you made. So, one should not put like everybody in one basket. So when we say foreign portfolio investors, you meet all of those guys. There are people who invest in India for 20 years. There are people who are hedge funds who are trading for 1 month. There are sovereign wealth funds. There are different kinds of mandates. Somebody just buying India because of allocation. There are different kinds. When we say retail, now retail also is very distinct. There is one retail who's doing SIP, wants to create wealth and want to secure their retirement. There is a retail who's kind of like doing some stock picking, investing for maybe few years or at least few quarters. There is a retail who is doing a daily trading and doing the F&O. So there are different kinds of retail. I think the number of those investors who are looking at wealth creation through a systematic manner and discipline, that number is increasing, and I think that we should not take as कि यार retail आ गया तो अब वो बाजार peak हो गया, because वो retail तो 4 साल से आ रहा है, right? 4,000 crore rupees per month was the SIP book in 2016. It has become 20,000, and I heard it several times. Now that so much of mutual fund flows, now is it market as peak? No, this is a new normal. This is US 401k movement of 1980s. This has just begun. This has just begun. This is a 20-30 year story of people and a large cohort in India which will increase to the people who are in their 40s and 50s. They have to save for their retirement for 30-40 years. This is US in 1980. What we are seeing in India from last 5-7 years. And this is a long way for next 20-30 years. The second part on the IPO, I think the number of new companies that are waiting for listing is humongous. Across so many sectors, when you go from $2,500 per capita to 3, 4, 5, 7, newer businesses would emerge. Newer businesses would emerge on investment side, on consumption side, on financial services, on technology, and many others. And PE and VC funded, so many of companies that we meet are yet to hit the market. And as the investment cycle kicks in, a lot of companies who haven't really raised money to invest, they will also raise capital. I'm very optimistic on primary market for next 5 years, several years in fact.
Okay. So much to ask you, but I know you got...
I'll give shorter answer maybe.
No. And I'll extend my appointment with you. Let me put it this way. That was not the cue. Pardon me if you thought like that.
No, come on.
No, my question...
Such a pleasure to...
Likewise. My question to you is, you look at the first term of the Modi government, it was dedicated towards financial rebuilding, Jan Dhan, repair of the economy, fixing the banks, fixing the power sector. Second term was about making India Atmanirbhar. Post-COVID, defense kicked in. You started talking about made in India for the world. So why am I extending this question is, let's say if you bought defense stocks in Modi 0.1, you did not make money. But if you bought defense and manufacturing stocks in Modi 2.0, you made money. Which are the themes and sectors do you think, because things are changing, world is changing, government policy will be differentiated, what do you think would be the standout themes of Modi 3.0? It is Modi 3.0 now, we all know that. So let's talk about it.
But credit to our fund manager, they started accumulating in the first regime, right?
Yeah, I know PFC,
for
RFC
our
had very
size, you
large
cannot
holdings.
get, and in defense and the whole manufacturing side, you won't get the size when everybody is buying, right?
No,
Then you know the
utilities,
price impact. It
utilities,
takes time to accumulate them.
So what are
and you
fund
have to
managers buying? Let me put it this way.
No, I think the universe has expanded. The good part is that universe has expanded now. Even when we talk about the manufacturing, I mean, the portfolio would be out or would have already been there, or you can see it. I mean, it's far bigger than what would have thought few years back, because there are so many opportunities within that larger theme also. And also, as we discussed earlier, that in last couple of years, maybe consumption hasn't done as well, because the focus was to kick in the investment cycle, which was, to me, was right, because you cannot have a structural growth without having investments, right? You have to create physical infrastructure. We also created digital infrastructure. Now I think the bigger focus on third regime would be on the social infrastructure, leveraging the power of digital technology. What we did on financial inclusion, what we have done on direct benefit transfer, what we have done on like delivering 800 to food grain to 800 million people, or Ayushman Bharat, or many of those things. Can we deliver same on healthcare, on education, on skill building? I think you will see transformational things in 5 years. I might sound more over optimistic on that, but I will put my bet that I think they will ensure that the power of digital technology, if it can be utilized for social infrastructure, education, healthcare, skill building, maybe more deeper financial inclusion, taking from the Jan Dhan to the Jan Nivesh, so on and so forth, and that will do a lot of good to the country. You are unleashing the power of 800-900 million people who are still not contributing enough to the growth potential.
So you've gone like this, now you'll go like this. Let me put it this way.
I think the universe is expanding
yeah.
for us, is expanding. And there are many newer businesses, very interesting ones.
Like?
The ones which are unlisted space, I'm saying, when we meet. Who could have thought a food delivery app, I mean, in few years' time would have this market cap, right? Who would have thought 5 years back? And there are many businesses like that.
So do you see the set of stocks which will do well in the next 5 years could be drastically different from the last 5 years?
Not necessarily, right? Necessarily. I mean, if you see the value creation last 30 years, there are giants. I mean, there are large cap companies which have become larger, and now they have become the giant. I mean, look at financial services, for example. I think some of the larger franchises still have so much of under penetration to serve. For next several years, for them, earnings growth won't be a challenge. But the derating that we have seen on the on the price to book or price to earning, but from an earnings growth perspective, I mean, so far, but from an earnings growth perspective, there is so much of an runway ahead.
We are discussing the importance of election cycle today, but a month from now we would be discussing budget. 3 months from now we would be discussing
you have
US
to run
elections.
a daily channel, right? You have to get daily. But the fact is, I think some of these things get kind of like,
we don't discuss COVID today. Think about it. We don't discuss COVID today.
We don't discuss COVID. How much time we discuss Russia, Ukraine? Sound very cruel. People are still dying, right? But in the studios, we don't discuss that. I think it's like that. I think not losing the macro picture at 3,000, whatever, less than $3,000 per capita income, 1.4 billion, the best demographics in the world in a democratic setup. We have a long way to go.
Okay. So based on the election cycle, the mandate, which is a clear mandate, I may argue about what I wanted versus what the real picture is. That's always what your expectations are. But you don't see there is any change, and you don't see the policy framework changing. That's part one of the story. Part two of the story is that the set of outperformers in last 5 years, you expect that some of them will continue to outperform in the next 5 years. Let's look at some data points here. One data point which Buffett uses, and which in a sense every fund manager is conscious of, is market cap to GDP. Your market cap is 4 trillion. Your market cap to GDP of stock market cap is 5 trillion. We are trading at a premium to market cap GDP. We are trading at P multiples of 18 to 20 times depending on the estimate you are looking at 1 year forward. When one looks at the historical return, when market cap to GDP is higher than the real world and the P multiples are 18 to 20 times, the future returns, they get compromised. Are we in for double-digit CAGR return for next 5 years, or that may not happen?
So when you look at market cap to GDP, you also have to see why US has that, because US had a corporate sector where the profits were growing higher than the overall GDP growth. In India, we have seen cycles. Corporate profit to GDP, I think, peaked around 7% or so, listed companies, if I remember correctly, in 2007. It fell below 2% during the COVID period. It is now back to 4.5%. Over the next couple of years, can it kind of like inch
goes
up a
to
little
seven and
bit?
a half, eight,
It can, which means you are going to have like, let's say, a double digit earnings growth. Can market deliver that over the next 5 years? So that because of this whole a little bit of correction, not so much, but let's say if Nifty is mota moti at 22,000, and if you're going to have 1100 rupees of funding, we are talking about like 20 times, right? Maybe one can argue at these rates whether, let's say, if there is for any reason a bit of policy uncertainty, maybe you take 1 or 2 P higher or lower than that. But 5 years later, if we are in a decent shape as an economy, we become 7, 8, 9 trillion dollar economy, and we become like, maybe can the market cap be not where, let's say, in line with this? I think one can argue it can be. And also add, I mean, the another thing which may not be the return to the investor today, but let's say all the new listings that will add to the market cap.
Okay. Now, I go back to that whole starting point once again, because this was a big risk. Beginning of the year, it appeared like a no risk. Now it turned out to be the other way around. But do you think this event risk, by the time things will settle down, it may just be a 10% volatile swing event, not more than that?
I think so.
10% up and down.
And a lot of credit in that is actually the domestic retail investors, to be very honest. I think this SIP flow is providing stability to the market. If market falls another 5-7%, there are a lot of stocks that come down significantly. You'll have the domestic institutions buying in. And also, I think from global investors' perspective, and all of them that we meet, you meet, I think they've been like kind of looking at India very positively.
Why
but
FI selling?
no
Why are
concern
they
has
selling
been
so
on the
much?
valuation side, that your valuations have been a little higher, and maybe the emerging market as an asset class wasn't getting money, and off late maybe China started doing well.
When
a
will they
little
come
bit.
back?
Just that tactical. I think as at a stock level also, if there are some of the stocks which have corrected a little bit more, you would see foreign portfolio investors putting in money, because the broader view on India is very positive. A structural view on India, I mean, look at US, the growth is all, let's say, UK, you look at Europe, I mean, people are bullish on Japan for a different reason. That's a corporate governance change at margin, not like a substantial earnings growth or the nominal GDP growth of the country. I mean, and most of the other emerging markets, where you get this kind of macro. And in the first regime, you forgot that the fiscal policy correction, the monetary policy framework, the overall macro stability from that perspective, banking sector and all of that were like huge reforms.
Yeah, I mean, I say that Japan has aged, US is aging, China, we don't know the real age.
Is aging
Europe
very
is the sixth
fast,
man.
and large part of the emerging market, the largest country, I mean, China is aging. India is the biggest. Actually, the world has such a large stake in India. In a democracy like this, as a counter influence to China, and the biggest growth driver, the potential largest consumer supplier and the labor supplier of the world. And strategically, world has a huge stake in India, and they would all like to see India does very well over the next several years.
Okay, before we wrap it up, 5 years is a time view. In next 5 years, private banks will do better or PSU banks will do better?
I think combination of both you need. I mean, most of my answer when within the sector you ask, I would say bottom up. I'll keep repeating that word.
No, but if I say in terms of specific themes, would you lean more towards private companies or public companies?
I think it's a little difficult for me to generalize that answer, because in some of the parts of public sector, I think narrative has overtaken.
Okay.
You need to be bottom up there. We own some of them. You need to be bottom up.
Okay. And one final question on this entire excitement in the small cap space. It's not just retail activity in SME and small cap stocks. It's also at fund level. I was looking at some schemes of some of your peers. The small cap funds have become large cap funds in many of the cases. Is there a bubble and a trouble in the small cap space? Because see, fund managers are getting money, they have a compulsion to invest. The more you get, the more you invest.
See, all of us over the last several months have been telling investors that don't extrapolate the return of last 1 year. When the index or the funds were delivering 50-60%, trees don't grow to sky. You cannot expect 50% every year. Don't put all your money in small cap. But at the same time, I would say there are 1,700-1,800 stocks. From a bottom-up perspective, there would be opportunities of stock picking. At the same time, I think we kept saying for last couple of months, there is a part of that market which is seeing froth, and it's good to see some of that froth correcting, which gives us opportunity to I think look at them from a longer term perspective.
And if I summarize today's interaction, while it may look like a very magnified kind of an impact, if I add back Friday's gain and Tuesday's loss and look at market, they're still up for the year.
Absolutely.
SIPs are strong.
Absolutely.
The policy continuity is going to be there.
Absolutely.
So why worry? Just take a chill pill, watch ET now, and if nothing else, go for a holiday.
No, don't take a chill pill alone. I mean, invest with a chill pill, but work hard. Country won't do well just because, I mean, let's say few people, somebody else have to work. All of us have to work together at $2,500 per capita. Think about like in 1940s when Germany and Japan got decimated, how every single citizen worked hard, whatever was their responsibility. We are doing a great job. We are trying, I mean, in all our humble way to ensure that we get more money from every investor, be the wealth creator for every Indian, and so that we can create wealth for them. Every single individual in India for next several years will have to continue to do that.
So,
but from a market perspective, best is do the SIP and you can chill from that perspective, but work hard wherever you are.
So, when I ask fund managers, give us a new tip, I think SIP is the new tip, right?
Absolutely. SIP is the new tip. Oh, that's a great acronym. We'll use it. In LP next campaign is coming, SIP is the new tip.
Really appreciate it.
Don't ask any tip. Just do SIP.
Really good to have you on.
Thank you so much. Always a pleasure.
Let's take a break.
If you like this video, then like, share and subscribe to ET Now.